One thing I do constantly is think about risk exposure and uncertainty. I try to actively think ahead on behalf of clients. What do they want and need? In doing that, I aim to be realistic in how to assess options, accepting that no one can be truly certain about anything. How can we combine asset classes to get people the returns they need while respecting how much risk they can handle? I know that many investors seek relief from decision fatigue, volatility anxiety, and the burden of constant monitoring. So I've set out to address those challenges, and I've come to a working framework that has taken a while. It took until a few years ago for the regulatory framework in Canada to truly make sense. Until then, client suitability revolved around the concept of strategic asset allocation. How much money was in cash, how much in bonds, and how much in stocks. It's only been in the past few years that the way regulators think about portfolio construction has been brought in line with the way most people intuitively think about market instability and investment suitability. The goal is to get people the return they need while experiencing risk that they can handle, but no more than absolutely necessary. And until recently, portfolio managers were obligated to write investment policy statements that spell out a client's strategic asset allocation based on discrete asset classes. Well, now, regulators assess suitability through the dual lens of risk tolerance and risk capacity. Tolerance is a matter of psychographic disposition. Capacity is a matter of investable asset levels and cash flows through income. Portfolios need to be constructed to reflect the more conservative of those two tests. So accordingly, products that are rated as low, medium, or high risk can be combined to create portfolios that correspond to a client's risk appetite. Regulators have even added two intermediate risk profiles, low to medium and medium to high. So think of all products rated on a scale of 1 to 5, with low risk as a 1 and high risk as a 5. So investors can mix and match based on risk-return characteristics rather than clumsy asset class depictions. Using 2022 as a case study, we can all see how this more contemporary approach is of great value to retail investors. Under the old model, a traditional balanced portfolio, 60% stocks, 40% bonds, would have been forced to lose money when considering rate hikes that everyone knew were on the horizon. Being forced to have a 40% allocation to bonds in what was almost certain to be a short-term bond bear is simply inconsistent with the principle of responsible risk management. The system was failing people, but mercifully, those days are over. So I'm now putting the final touches on what will come to be known as Standup Portfolios, a proprietary framework for portfolio construction that takes a more contemporary, pension-style approach to wealth management. It aims to remove the failure points that were part of the old paradigm. There will be two distinct models, a growth model used predominantly by those that are still in the workforce, and a balanced model used primarily by retirees. Both will have an identical core of 9 mostly medium risk products, and all product allocations will have a target weighting with a minimum allocation of 5% and a maximum allocation of 10%. All will feature 9 products as core holdings. The growth portfolios will have 4 additional products that are more aggressive, where the balanced portfolios will have 4 different products that are more conservative. When switching from the growth model to the balanced model, typically at or near retirement, there will be relatively little portfolio turnover because only 4 products out of the 13 will need to be switched. It's especially notable that there are several products that have come on to the market recently that are not only medium risk but also weakly or negatively correlated to one another. So combining these products, which is to say diversifying the diversifiers, can lead to an extremely stable glide path where it's highly unlikely that investors, and especially retirees, will experience drawdowns. I'm looking forward to using the stand-up portfolios as a new paradigm for portfolio management, and I'm highly confident that investors will appreciate the stability they're likely to provide. This is a huge step forward in client-centric portfolio design and a huge win for investors. The world has changed, and it's high time that portfolio construction changed with it.